Broadcasting from Baltimore, Maryland, and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here is your host, Dan Ferris.
Hello and welcome to another episode of the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value. That's a value investing service published by Stansberry Research. We've got a really cool show with an awesome guest today, so let's just get on to it. Okay, it's time for my weekly, I'm going to call it my weekly perturbation, which is a crazy word, and I'll explain it at the end of the show in the mailbag. I don't know if I'm really going to call it this every week, but I just thought it was funny to do it this week. So the weekly perturbation is about gold, because it's up a bunch recently, about 7 or 8% last few months here. And it's just coming on really strong, and I don't see a lot of people talking about it. I went to both the Wall Street Journal website and the Financial Times website just before we started recording my words here, just a few minutes ago, and I just typed in the search box the word gold. And at the Wall Street Journal, I got zip, zero, nada, nothing. On the entire front page, scroll all the way down, nothing. Financial Times, I got one mention of gold. It said gold hits 6-year highs, and there was a link to a short article. And I think that's a little odd, don't you? I mean, all of a sudden, gold has come on super strong. And I think we need to talk about this. It's at a 6-year high. It's outperformed, just in the past few weeks here, it's outperformed stocks and bonds, both of which are up, by the way, and just about everything else. Investment-grade bonds, junk bonds. I think the only thing it hasn't outperformed is Bitcoin, which we're actually going to talk about that a little bit too. So there's this one report on Yahoo that came out, I think, yesterday, and they said Citigroup expects the metal to reach $1,500 to $1,600 per ounce. This always happens when something goes up real fast. Some big bank says, hey, it's going to go up even more over the next 12 months. I don't think I disagree with them, though, in this one. I think over the next 12 months, we probably will see $1,500 or $1,600 gold. In fact, I think if this move over $1,400 holds, you're going to see $1,600 and maybe even new highs like $1,900 faster than you would have anticipated. And this strategist from, Q-Tone Investments, never heard of them, says that investors are getting ahead of themselves with the gold rally, and historically over the past 150 years, equities have returned anywhere from 12 to 15% on average, gold 1% on average. That's a really dumb comparison, isn't it? Because equity is a share in a business, and gold is money. I realize 50% of the supply is in jewelry, but really gold is money. So comparing the dollar performance of gold and equities over the last 150 years makes no sense, because for most of that time, gold was pegged to a certain, it was used for the backing in the currency to a certain degree. I mean, the Bretton Woods system wasn't really that great. I mean, you and I weren't allowed to redeem for gold, but, countries and big banks were. And gold was, the official gold price in the United States was like $35 an ounce, and then they raised it to $38, and then they raised it to the current, I think 38 was 1973. They broke the tie with gold in 1971, and sometime after 73, they raised it to the current official price of $42.22 an ounce. But who cares? The market doesn't care, and it's over $1,400 an ounce. So if you take gold's performance since the official price, or really since 1971, since we broke the last vestige of any backing of the U.S. dollar with gold, it's from 35 to 1,400. That ain't bad. So the next question, of course, is why? This is a standard thing that everyone wants to know, why. And I think the answer really is in the action since the last Federal Reserve meeting. Basically, they said, we're not going to do anything. We're not going to cut. We're not going to raise. And people took their comments sort of dovishly. In other words, they think they're going to maybe cut rates. And that talk has been going on for some time now. And so what you're seeing, I believe, if you need to interpret why gold went up so much in such a short period of time, which I don't even know if I really need to do that, but if you force me to explain, put a gun to my head, what's going on, it's like this. We're 10 years into a huge bull run that started in March 2009 at the bottom after the financial crisis. And during that time, we saw, zero interest rate policy, so-called ZIRP. And, then the Fed got in and they raised rates, like 6 or 7 times. It doesn't matter. And, of course, then we saw what happened last fall. Stock market down 19% from the September high to the Christmas Eve low. And so the Fed went, wait a minute. We're raising too fast. And, of course, President Trump tweets, you're raising the rates too much, And so the Fed basically agreed with him and said, well, boy, we're raising rates too much. And they may actually wind up cutting them. And I think the market is discounting that. So stocks are up. That's a standard thing, right? The Fed cuts rates, stocks go up. Bonds go up, right? Interest rates are lower. But gold going up a lot, and even like Bitcoin having quite a rally here, that tells me that something else is going on, too, this time around. People are getting skeptical. They're saying, something, there's only so much that you can expect the Federal Reserve to do by cutting and cutting and cutting rates. The Federal Reserve, this is not a magic wand. They don't wave a magic wand over the market and prevent it from crashing and prevent it from falling. And they don't wave a magic wand and support asset prices, period. Real estate, stocks, bonds, whatever you think they're doing, whatever they think they're doing. And that is clearly what they're up to. They're not even hiding it anymore. This mandate of full employment and 2% inflation or something. The Fed is not, they're not thinking about that. They're thinking about supporting asset prices because they know there's a wealth effect that comes. People spend more money when their 401ks are up, and they're trying to support that. And the market eventually, of course, gets wise to these things. And I think that is exactly what is happening here. The market says, oh boy, they're going to cut rates now? After 10 years, zero interest rates? And then, they raised rates, whatever it was, 6 times and 4 times last year. And then the stock market went down. And so now they're dovish, and they're probably gonna cut rates, and the market probably thinks that too, or the market definitely thinks that. If you look at the futures market and what's happened with gold, and that really is what's happening. People eventually, if you screw with the money this hard for this long, the market's gonna say, okay, uncle, I gotta have some gold, gotta own gold, and then. There's a technical effect too, right? All the technical people are watching and they say, well, if gold gets over, I think it was 1350 was a key level. Oh boy, that's a big deal. If it can sustain that over 1350, then 1400. Oh, if it can sustain this, wow, that's good. And then as I'm talking to you, I think gold is around $1,430 an ounce. And, not too long ago, it was below 1300. So that's a heck of a move. So that's my belief. That's my belief as to why gold is up. So, then of course, good investors ask, hey, what's next? What's in store for the future of gold? I wish I knew is the answer. Actually, though, I do know, don't I? And so do you know, too. You know that you don't know the future. That's what we know. You know that gold tends not to correlate with financial assets. We're near the end of a long bull market. Stocks are very expensive. Bond yields are tiny. The Fed thinks it can do anything with interest rate policy and a heavy dose of jawboning, right? you also know that the Fed is kind of delusional and that cycles matter. Nothing goes up forever. And in fact, the cure for high prices is more high prices, and the cure for low prices is more low prices. And we're at the high end on stocks and bonds and real estate and financial assets. So, there's got to be some kind of a correction or a bear market or something around here somewhere. I don't know if it's, 2 months away or 2 years away, but there's got to be something around here somewhere because things just don't tend to stay this expensive for this long. So then, what should you do, right? That's what you really want to know. What should I do now that gold has just run up so quickly? Should I buy a bunch right now? Because that's what everyone feels like doing, right? You always feel like buying a whole bunch of whatever just went up a whole lot. Let's think about that for a moment. When we say buy gold, there's a lot of options, right? You can buy gold stocks, you can buy gold bullion, gold coins, you can buy a gold ETF, that owns gold. You can buy gold futures. Did I say that? Gold futures. You can do lots of different things, okay? What should you do? Well, that's up to you. Financial advice for an individual, it's like the most individualized thing. You got to know yourself. But I have some ideas if you are of a certain mind. If you think that it's good to own gold because the U.S. dollar will not always be around because fiat currencies always fail. In history, they've always failed. Then it really doesn't matter how much you pay. Whether you pay, $1,400 today and the price goes to $1,300 tomorrow, you don't really care because you're going to buy that gold and you're going to hold on to it and you're going to hope you never need it. It's just prudent diversification and a very, very long-term perspective. Hope I don't need it. Boom. Some people say 5% of your assets for that kind of a thing. I don't know. I think they pull 5% out of their, nether regions just to try to sell you gold. But it makes sense to me. So that's one thing to do is to buy gold bullion coins like Krugerrands or American Eagles or something like that if you think that you should hold some because the currency isn't going to last forever. And if you think you should do that, who cares whether it just went up 7 or 8% in a real short period of time? It doesn't matter. Okay? So if you're buying gold futures, the fundamentals. I'm going to start that over because I got that chime in there. If you're buying gold futures, the fundamentals matter a whole lot less because you're probably trading on some kind of technical signals. Futures aren't like a long-term investment. Although some people, a really simple strategy is to buy the front month contract and just keep rolling it over. If you think we're in a bull market, we're going to stay in a bull market. That's what some people do. But if you're trading futures, you're not waiting for me to tell you what to do. You already know what you're doing. That's a sophisticated, risky instrument, and you don't need me to tell you. Gold stocks, well, hey, I've recommended 3 companies in my newsletter related to gold, and they're all doing, pretty well these days. So if you think that you want to own gold equities, that's a different thing entirely. That's there's the macro reason for owning gold involved there, but there's also the micro, which gold equities, and there's a whole huge spectrum to choose from. At the bottom, the riskiest end is like, people who think they might be sitting on a whole bunch of gold in one hole in the ground somewhere in, Moose Pasture, Canada or someplace. And then at the other end is probably like the best gold royalty companies, like a Franco-Nevada or something like that. Or frankly, the companies that I have in extreme value, which I can't mention because people pay a whole lot of money for extreme value, but I really genuinely believe that we have the 3 highest quality businesses in the gold and mining space in general in extreme value. So if you're going to do equities, do you want quality or do you want to try to take a flyer or somewhere in between? That's up to you. So those are the two things that really matter the most to me is, bullion or gold equities. And I hope that sheds a little bit of light on how to think about those. And of course, gold has all these properties. It's got the Lindy effect, doesn't it? It's the Lindy effect says, if something's been around for a long time, it'll probably be around for that long in the future. Gold's been around. We've been using gold as money for 5,000 years, 6,000 if you count the use of electrum, the naturally occurring alloy of gold and silver. But at least 5,000 years. So, we should probably expect it to be around 5,000 years from now. That's what the Lindy effect says. And it's useful, and it conducts electricity. It's divisible. You can divide it into the tiniest amounts. It's one of the most ductile metals in the world. You can pound a single ounce of gold into a sheet that's almost 100 square feet, like really super duper duper thin. Or a single thread, 1 ounce of gold, a single thread, you can stretch it into a single wire 50 miles long. I mean, it's like 5 microns wide, but you can do it, theoretically speaking. So it's really, it's a useful thing. It's really expensive, so the biggest use is jewelry. Just shy of 50% of all the gold in the world is in the form of jewelry. And, so there are these properties about it that are the reason why it's been around 5,000 years and will probably be around another 5,000 years. So, what should you do right now? Probably nothing different, right? As I sit speaking to you here on the podcast, I've got these 3 companies in my newsletter that I think are a good idea. And they remain a good idea as long as they're below my maximum buy prices. So my advice there isn't changing. Gold went from 1,300-ish to 1,400 really fast. Hasn't been much mention of it in the press. We got this one report that I mentioned of the guy on Yahoo saying, gold is overdone a little bit, and it's due for some kind of correction. The price of gold is not correcting as I'm speaking to you. It's up another $10, $9 or $10 to around 1430-ish. But like I said, I can't help noticing that the Wall Street Journal, Financial Times, for just 2 examples, they really aren't saying anything much about it, if they're saying anything at all. So, sure, there could be a correction, but I really believe that this push through $1,350 and $1,400 an ounce is the real deal. I think this is the start of, a move that's going to take us eventually to new highs, 1,900 and higher. How soon that'll happen, I have no idea. 6 months, 12 months, 18 months, 2 years? I can't tell you that. But I can tell you that I think gold's definitely seen the bottom, right? The bottom was like 1050 or something, and now we're at 400. In fact, if you take the top from 1900, which was 2011, and then you take the bottom at 1050, which I guess was 2015. We haven't gone halfway back, that distance. I think halfway back is like around 1450 or 1460 or something. So we're just about there. We're just about halfway back, and I think eventually gold does take out, its old highs of 1900, and by then, of course, even at 1400, a lot more people are making money mining gold who weren't making it before, and 15, 16, 17, 18, 19 and higher. Of course, the supply is going to come out of the woodwork. But the funny thing about gold is it's not really about the supply for use. It's about the supply for hedging and investment. So it's different. Because look, if we cared about if the supply of gold were really affected things a whole lot, the price would never go anywhere, because we've mined 190,000 tons. There's about 35,000 ounces in a ton. We've mined 190,000 tons of gold in all of history, and it's still above. It's all above ground. It's still there. just about all of it. It's hard to destroy this stuff, and we don't like to destroy it. And most of it is just sitting in, most of it's in jewelry. The rest of it's sitting in coins and bricks and stuff in vaults and places. So, some of it gets some technical uses of various kinds, but mostly it's jewelry, coins, and bricks. And, if the supply meant anything, well, we'd all be screwed, because the supply just grows and grows and grows by like 2,000 or 3,000 tons a year. But that's not what it's about. It's about other things. The U.S. dollar, the actions of the Federal Reserve. People get nervous. They think there's going to be a catastrophe, and they think they need to own gold. And I think they're right. Okay? So I think you should own gold. I don't think owning physical gold has anything much to do with the current price or the recent price action. I think that has more to do with whether or not you own a particular gold mining company or a gold royalty company. I think the royalty companies are still good buys at this level, and that's where we are right now. So that's the weekly perturbation. Let's talk about what's new, and then we're going to have a really, really, really good interview. Just a couple quick things in the news here. Just a few quick things. One of them, I said I'd mention Bitcoin, and Bitcoin is at 11,000. It hit 11,000 for the first time in more than a year this past Monday. And that was the impending launch of Facebook's Libra cryptocurrency that we talked about in the last episode of the podcast. So the Bitcoin is up more than 170% so far this year. And that makes sense. It was way the heck up, and then it plunged like 90% or something, and now it's had this big rally. And I'm still on the fence about Bitcoin. I bought some. I bought $1,000 worth just so I have skin in the game, so I can just sort of, it causes me to think about it more, even if I just have a tiny amount of money in it that I don't care about. And, I've noticed some things. I mean, Expedia takes Bitcoin, Microsoft takes Bitcoin, KFC, the Colonel, fried chicken, KFC Canada takes Bitcoin. I'm trying to figure out if some Subway locations still take Bitcoin. I don't really have that one, but they did if they're not still doing it. And you can buy things with Bitcoin. It acts like a currency, which is crazy to me, because the value went, it was like close to 20,000, if not 20,000, then wham, crashes down to like, 2,000 or 3,000? I don't even pay attention to this stuff that much. I just know that it was way the heck up. I thought it was insane, and then it crashed like crazy, equally insane, right? Or maybe that was the insanity coming out of it. And now it's back up, 170% this year. And it's 11,000. So 11,000 US dollars. And you can use it. You can use it on overstock.com to buy stuff. And you can use it on Amazon too, not directly. You have to do something. There are some steps to use it on Amazon, but you can use it for money. So you're never going to hear me say Bitcoin is garbage and I know how it's going to turn out, because I don't know. And I think that Bitcoin being up a bunch recently, it's for some people, that's the place to go when you are at the end of the cycle and you're scared about the U.S. dollar and you're scared that the Fed is going to ease interest rates too much. That sure is what it looks like. Could be a coincidence, and it could be a dead cat bounce, right? We'll see. But I think it's something to pay attention to. All right, next in the news, of course, the value investor has got to point out a story on CNBC. Here's the headline. Goldman Sachs says value investing is still alive if you play it with this twist. And they point out that the valuation gap between the most expensive stocks and the cheapest stocks is now the widest it's been in 9 years. And that has historically, according to Goldman Sachs, foreshadowed a strong performance for the value names. And the Goldman chief equity strategist David Kostin says, quote, a rotation into value stocks would require a sustained improvement in investor economic growth expectations, potentially driven by global monetary policy easing. Right? So this guy's saying, well, I don't know about gold, but value stocks are probably going to outperform if we get this Fed easing. For optimistic investors, just reading this CNBC bullet points here. For optimistic investors who want to bet on value's grand comeback, Goldman has screened for value stocks with a quality overlay. So instead of just picking cheap stocks, they're picking what they say are stocks that are cheap, that are really good businesses. And their value basket includes Qualcomm, Salesforce, and Facebook. Certainly not traditionally cheap value names, right? So that's the quality overlay is the twist that they're talking about. And I don't have any problem with that. One of the things you learn as an investor when you start out as an investor, you look at what you know, which is the price, and you try to figure out, what's going to happen on the price chart. And then the next thing you do is, you're trying to figure out what the hot technology is. Then the next thing you do, what's the hot industry? And then eventually you find yourself looking at individual companies and trying to figure out individual businesses. And maybe you become a value investor and you start looking for what's cheap. Then you go to the final step where you say, wait a minute, I'm going to screen for the best businesses. I'm going to learn what is a great business. And if this sounds familiar, it is familiar, right? That's what Warren Buffett did. He did all that stuff. He was looking at price charts and figuring out odd lots and all this other stuff. And then he discovered value investing. And he played the sort of statistically cheap game for a while. Then he met Charlie Munger. And Charlie Munger said, hey, why don't we just buy great businesses and hold on to them for a long time? And that's where they are now. And that's where they've been for decades. And that's where most great investors wind up. And I think I'm going to leave the news just at those few items. There's a lot more going on in the world, but let's just leave it at that because by now I think we should have today's guest on the line. All right, it's time for our interview, and today's guest is Albert Laszlo Barabasi. He's the Robert Gray Dodge Professor of Network Science and a distinguished university professor at Northeastern University, where he directs the Center for Complex Network Research and holds appointments in the Department of Medicine at Harvard Medical School and the Central European University in Budapest. A native of Transylvania, Romania, he received his master's in theoretical physics at the, forgive me for the pronunciation, Eötvös University in Budapest, Hungary, and a PhD at Boston University. Barabasi is the author of Bursts, The Hidden Pattern Behind Everything We Do, Linked, The New Science of Networks. He is also the author of Network Science and the co-editor of The Structure and Dynamics of Networks and Network Medicine. The titles have been translated into more than 15 different languages. His work has led to many breakthroughs, including the discovery of scale-free networks, which continues to make him one of the most cited scientists today. Laszlo, welcome to the program. Thank you for being here.
It's a pleasure to be with you. Thanks for inviting me.
So, Laszlo, the first thing we need to do is, you're not our usual type of guest. We usually have people who manage money for a living. So let's just talk about what you do as a network scientist. My wife said networks. People networks or computer networks? And it's all networks, right?
All of the above. So network science is a discipline that was born about 20 years ago that tries to develop a language to think about all kind of networks that pervade our life. And, this is kind of grew out from the realization that just about everything we do through networks. We communicate through networks. Our friendships and professional links can be really perceived as a network and have to be perceived as a network. Our business ties are there. But even our very biological existence is made possible by the intricate metabolic and genetic networks within our cells. And about 20 years ago, a movement has started in science to quantify these networks. And hence, today I'm a network scientist who studies all of these networks and many more.
Okay. Now, I want to talk mostly about your book, The Formula, which I could not put down. I think it's an excellent book. And the first question I have for you is you said a couple of times in here how the book is about the laws of success. It's called The Formula, the Universal Laws of Success. Are we really talking about like the law of gravity type laws? I mean, that's what you say in the book. It's really that kind of a law?
I tend to think it is. These are patterns that we extracted by studying the career of millions of individuals. And if you are in the right conditions of your career, we think you cannot avoid that. Hence, they really elevate at the level of laws. Now, not all laws always apply to us. You know, as I'm walking around talking with you, you know, Bernoulli's law doesn't apply to me, but if I start to fly, which is a gas law, then suddenly the only reason the airplane can fly with me is because the Bernoulli's law applies to us. So fundamentally, when these laws apply to you depends on the circumstances you find yourself in, but these are very generic patterns that apply to all individuals at that stage of their career.
Is it accurate to say that you basically study anything that behaves like a network, and the phenomenon of success among human beings is a very scientifically hard version of that? Success is a science, a real science.
Well, we certainly would like to think so. And the reason why I got into this is that much of the studies that we've been doing over 20 years focused on how the network looks like, how it evolves in time, and so on. And about 10 years ago, we started to think of a complementary problem. Okay, I'm a node in the network. How does this node affect my success? Does it help me? Does it pull me back? And whether my position in the network will really determine my long-term success. So we went after this question, and then we realized that if we want to answer it, we need to step back and address much deeper questions, like what is success? What is performance? How do they relate to that?
Yeah, so let's talk about the difference between performance and success. You gave great examples of performance with tennis players and golf. You know, who'd you talk about? Roger Federer and Tiger Woods. They're examples of great performance, right?
So what is interesting is that as we grow up, one of the things we learn in school and on the running field and everywhere else where we go is that you need to have performance to have success. And in a way that performance really drives success. So the question is, what's the difference between them? Because in our vocabulary, we often use it interchangeably, thanks to this strong belief of the relationship between them. And from a data perspective, since I'm a network and data scientist, we have to be able to distinguish them. So our approach was relatively simple and straightforward. Performance is what you do, how fast you run, what kind of deals you put together, how do you invest your money, what kind of paintings you paint. However, success is what does the community notice from that performance, whether it acknowledges it, and whether it rewards you for that. In other terms, your performance is about you, but your success is about us. We as a community reward you with success for your performance. And from a data perspective, that's a very important distinction because as we'll see during this discussion, as I discussed in the formula, in many areas, performance is very difficult to measure at the individual level. But success, because it's a collective quantity, it's easily measurable because there are multiple data points around you that pertain to your success. So measuring success and characterizing success becomes a big data problem.
So let's talk about a concrete example. Let's talk about the difference between, Tiger Woods and Roger Federer versus the artists you mentioned in your book, Diaz and Basquiat. What's the difference?
Sports is a very special area and kind of unique in terms of human performance because in sports, we have very accurate measure of performance. If you are a runner, I have a chronometer and I can measure your speed, and your speed uniquely determines how well you are regarded as a runner. And indeed, we actually ended up analyzing the tennis players like Roger Federer and all men and women tennis players' performance, how well they do on the field, as well as their success in terms of how many people actually follow them, how many people visit their Wikipedia page, how many people search for them on Google, and so on. And what we found is that in those cases, performance uniquely determines success. That we were able to actually build a formula that if I plugged in where did Federer play last week, against whom, and whether he lost or won, that formula tells me uniquely how many people went and visited his Wikipedia page. So starting from a performance measure, we were able to very accurately predict a success measure, which is curiosity about the particular player. But as I said, this is unique to sports, because in sports we have chronometers, we have accurate measures of performance. Most of us, however, live and work in areas where performance is much harder to gauge. And this is not to say that you can distinguish the good from bad, but there are actually many individuals with kind of comparable performance. Now, coming back to your question, sports is one area where performance can be very accurately measured. The other extreme, where performance is inherently impossible to measure, is arts. Is this microphone on the table in front of me, is this an artwork or it's purely a microphone? Well, right now in front of me, it's a microphone. If you see it on the pedestal in MoMA, under a glass box, it's an artwork. Would you be able to look at the object itself and distinguish whether it's an art or an ordinary object? In contemporary art, that's virtually impossible. So therefore, you cannot use performance measures to really see how well art does. It all depends on the context. And then you have to start developing other rules and tools and laws to describe how success emerges when performance is not measurable.
And I was fascinated by the difference between the two artists you talked about, Jean-Michel Basquiat and his partner, what was the name, Al Diaz. And their work, some of their works were virtually indistinguishable, yet we don't know, nobody knows who Diaz is, but lots of people know who Basquiat is, and his work sells for millions of dollars. What was the difference between the two of them?
I'm glad you kind of pointed that out. Indeed, for me, the Al Diaz and Basquiat example is a perfect example for what I would call the first law, is that when performance can be measured, networks drive success. And indeed, we're dealing with two artists who started their career together in the 1970s in New York. Not only they started their career together, but they really worked together under one single name, the name Samo, and they did graffiti art. And they did so for about a year and a half when they broke apart. And within 3 years, their trajectory completely diverged. Al Diaz is still alive today, working in the New York art scene, and if you haven't heard about him, there's a reason. However, Basquiat, 3 years later, paints a painting that became the most expensive painting sold by an American artist a few years ago. And so what's the difference? Well, fundamentally, networks. When you look at the career of the two individuals, Al Diaz approached art from a performance perspective to say, it's about making the right artwork at the right place. However, Basquiat immediately recognized that he has to embed himself into the community of artists in New York, and he befriended, within a few months interval, some of the biggest names of the art world, like Andy Warhol, and actually moved in and lived in Gagosian's apartment, who later on became, of course, today is the biggest art dealer out there. And so Basquiat has mastered the network that really mattered at that moment in the art scene of gallerists and other artists. Al Diaz, however, continued to approach art from a performance perspective as trying to produce more and more works. And of course, the difference is huge. And what we did is that, of course, the book doesn't only rely on anecdotes. I have had the possibility to get access, thanks to Magnus Resch, a gallerist in New York and an art historian in New York, to an exceptional data set that allowed us to track the career of every single artist in the last 40 years, both in America and abroad. 500,000 artists were in the database, and we could fully reconstruct their career. And what we found there, that in case of artists where performance is unmeasurable, there's a hidden network of institutions that could be mapped out with this data, and that network uniquely determined their success. And this was not only kind of a finding that that network determines their success, but we were able to turn that one into a predictive tool such that if you give me your favorite artist's name and the last 5 exhibits that he or she had, I can fast forward her career and tell you what level of institutions would actually be really exhibiting in 10 or 20 years from now. And the reason we can do so accurately is because performance is not measurable. All the predictive power is in the network. Where you are in the network, whom are you connected to, what is the prestige level of those institutions. So art is a perfect example of the first law of the formula, saying when performance is not measurable, it's networks that determine success.
Now, I'd like to skip over, if you don't mind, the second law of success in your book, which is performance is bounded, but success is unbounded. And I want to talk about the third law, which says that previous success times fitness equal future success. Can you tell me, what's fitness? How do we define fitness?
Sure. And before we go to fitness, let's first talk about the previous success determines success. And this is a discovery that I made almost 20 years ago while we were studying the World Wide Web and trying to understand why do we have certain web pages like Google and Yahoo back at that time who had such an exceptional number of links from other websites, and why is my website hardly acquiring any links from outside individuals. And what we realized there is that the only way to explain mathematically what's happening and what drives the emergence of these hubs on the web is that success drives success. That is, the more links a certain website has, the easier it is to find it, and the more likely that it will actually acquire further links from other websites. And then we soon realized that this is not only unique to the World Wide Web, but in all areas where you have some measure of success is true. It's certainly true for money. People kind of end up acquiring money in proportion to how many they already had. If nothing else, that's what compounding interest is. But it seems to be true also for scientists of how they acquire impact, that the number of citations my papers get is proportional to how many they got in the past. Now, the problem with this rule is that it just simply says if you have a lot, you will get more. Well, how do you get a lot to begin with? And that's where fitness comes along, because we realize that there are differences between websites. Some websites like Google are acquiring links much, much faster than mine, not only because they have more links, but because they offer services that are more desirable to the public at large than, say, what my website offers. And so we named these differences fitness. Fitness is the node's ability to acquire more links, the person's ability to acquire more money, to earn more money, your ability to acquire more friends. And the way this works is that, how popularity determines how easy you are to find. But once I found you, it's your fitness that determines whether I want to link to you, whether I want to give money to you, whether I want to become friends with you, whether I want to write a paper with you as a scientist, and so on. So really, and fitness is unique to each individual, and it's not something that you as an individual determine, but it's something that the community assigns to you based on what you have to offer to the community. And this fitness is actually measurable in many contexts, like case of the World Wide Web, what's the fitness of the website. And therefore, we arrive to this third law saying it's previous success times your fitness that determines your future success. That if you have low success to begin with by high fitness, you will acquire links faster. And it could be very, very successful that you have a high level of success, but for whatever reason your fitness drops, then you will actually stop growing and you will stop actually acquiring further links or further money and so on. And your growth will slow down.
So Laszlo, fitness to me sounds like it's another way in which you're saying this is the network's assessment of your performance or your fitness. They sound very, it sounds to me like it's the network saying whether or not you're good enough, whether or not your performance is good enough. Is that accurate or no?
Absolutely. Yeah, absolutely. So it's a measure that the community assigns to you, and it's really a competitive measure, how much more attractive you are than the person next to you. And of course, this doesn't happen by simply comparing pair by people, but simply if you have a large community who's choosing between different individuals, between different services, before different songs, they, through their joint action, they slowly start assigning a fitness to each node. And that fitness, which it's not written on any of that, but it's kind of measurable, eventually determines their growth rate.
Right, and it depends on what the network is looking for. For example, if people like a good female singer to also be very pretty, a better female singer who isn't as pretty might not be deemed as fit.
Certainly, but also depends a little bit of what community are looking at it, right? So I'm sure that my parents' generation would assign a completely different fitness measure to a Britney Spears song than my generation or my children's generation, right? So the fitness is kind of incorporating this subjective judgment about whether I like it or not, but because so many people are voting on you, on the object or on you, at the end there's a unique number that allows me to say how fast you would be growing in that particular environment.
One of the things that gets me about the emphasis on previous success, when I got to that point in the book, I was kind of depressed because I thought, well, I've had some success, but maybe not so much, let's say. But you give me hope with your fifth law, and I'm skipping the fourth one for now. We can get back to it. You give me hope with the fifth law because the fifth law is with persistence, success can come at any time, even late in life, no?
Oh, I'm so glad that you jumped there because that's really my favorite law. And let me give you some background.
Yeah, me too.
I just passed 50, and based on all the data out there, my chance of creating an innovation, writing a research paper that would overcome my earlier work, statistically is close to zero. What do I mean by that? Yep. It means that when you look at the career of high-performing individuals, there is overwhelming data to indicate that many people make their most important discoveries, contributions to society, to art, relatively early in their career, in their 20s and 30s. And this is so severe and so persistent that Einstein once claimed that a scientist who doesn't make his big discovery by the age of 30 will never do so. So the question we ask, well, that's certainly very bad news for me, because it suggests that really I should stop doing what I'm doing, which is running a lab and trying to make new discoveries and publish them. And maybe I should just write books. Sounds like you like my book. Maybe that is my next career, because the chances are of making a discovery that would be bigger than I did before is close to zero. Well, we were curious. Let's look at the data, and let's not only look at geniuses, let's look at everyone and ask ourselves, is it really true that only young people tend to be innovative? So we analyzed, for example, all the careers of all the scientists from 1900 to today in all disciplines, and we confirmed that that seems to be the case. That is, most scientists write their most important paper, whether that's a Nobel Prize-winning discovery or something that no one remembers 10 years later, right? They do so relatively in their kind of like, roughly 10 years from the beginning of their career, which is what we call the academic age. So we confirmed what the belief that was out there for a long time. But then we're data scientists, so we started looking a little bit more carefully at the data and look for the placebo effect. What would happen if I make my discoveries completely randomly? That is, what happens if any of the papers that I ever write could be the most important paper of my career? What happens if any of the business deals you put together could be the most important business deal for your career? What if it's completely random in the space of the deals, of the papers you write, and so on? And so we said, let's see what happens in the case of random careers. And to our surprise, we realized they were indistinguishable from the real ones. And once, to make this long story short, what we realized is that really what changes during the career is not the creativity, but the productivity. That is, young people tend to put lots of projects out, and as they age, the number of projects decreases. The people are not trying any longer. However, what we showed is that each project a scientist puts out has exactly the same probability to be the highest success project in his or her life. So a little bit, discovery innovation is like buying lottery tickets. Every lottery ticket has roughly the same chance of winning. But if you buy most of your lottery tickets when you're young, it appears that you have to be young when you win the lottery. And it appears that old people cannot win the lottery. So at the end, what the fifth law does is that it summarizes really this key discovery that we made a few years ago in my lab, that really innovation is not about age. Innovation is about persistence. And those individuals who keep trying can be truly innovative relatively late in their life. And my favorite idol in that space, an example, is what I discussed in the formula, John Flann. John Flann is a scientist who was a chemist, and he worked at Yale University. And at age 65, or 70 actually, he was forcefully retired by Yale University. This was kind of in the 80s, 70s and 80s, when there was still a retirement age. And he was still full of energy. So instead of actually retiring and leaving his lab because they closed his lab down, he moved on to another university, Virginia Commonwealth University, started a new research lab, and it was there where he published his greatest discovery of his life about electrospray ionization that 15 years later, at age 85, landed him the Nobel Prize in chemistry. And I don't think that John Flann is special. I think John Flann is just an example of an individual who simply believes that creativity doesn't wane with age. And he just kept trying and trying and trying. And he just actually passed away a few years ago at the age 90-something. And, 3 days before he passing away, he was still in the lab working on the next research paper.
So that's a message of great hope for me, because I'll be 60 in 3 years, and I really have no interest in slowing down at this point. And you're giving me a lot of hope that my efforts will not be in vain, because success could come at any time. But this topic is really good for investors, isn't it? Because, we buy a portfolio of stocks not knowing which one will be the best performer. If we knew that, we'd only buy that one. So we buy a portfolio because we persistently, change the portfolio over time, never knowing which investment will become our greatest investment. But the point is to stay in the game, to survive and stay in the game. It's a wonderful message.
Absolutely. And if I may add something to that, before you think that this is only something applies to scientists, think twice. Because after the formula was published, a colleague of mine, two colleagues of mine from Northwestern University and MIT, have looked at the age effect for the founders of the startup companies. And if you want to think of one area where really youth really dominates, that's Silicon Valley, right? And the belief that you have to be in your 20s to start the next Facebook or Google. And, that's certainly to some degree true and held very closely by the community, because if you look at the biggest Silicon Valley awards, they all go to to people in their late 20s or early 30s. And when you look at the major firms, the major 5 firms, and the age distribution of the founders of the company they support for the first time, it's late 20s, early 30s. So there's a deeply held belief that if you want to make it in Silicon Valley, you need to start early and you need to be successful early. Yet, what my colleagues have done is they looked at not only what age do they actually get these kids the investment, but they also asked, will they succeed? That would a company be sold as an IPO or be sold or get an IPO? So they measured success in terms of, is there a successful exit? And what they found is that, yes, a huge number of investments go to young people, but the success is not staying with them. And actually, a 50-year-old founder has about 3 times higher chance of having a successful exit than a 30-year-old founder. So, yes, the belief is very strong, but it doesn't mean that it actually leads to success. And you know, Silicon Valley is no different from the other areas of performance. You have to keep trying, and often the biggest successes really come relatively late in time. So yes, the Google founders were young, but they needed an Eric Schmidt to turn into Google what it is today.
Wow, that's great. I had never heard that before. Laszlo, we're actually towards the end of our time here. So I usually like to ask, you know, if you could just leave our listeners with one thought about your work with success and networks. I realize it's asking a lot because you've done a lot of work and made a lot of discoveries. But if I asked you to leave them with one thought, what would it be?
The most important thing I learned from the formula is really that your success is not about you, but about us. That is that if you want to be successful, it's not enough to have performance. You really need to see how the performance is being achieved, recognized, and seen in the community around us. And to me, that's a very humbling experience because it really helped me understand that every decision I go for going forward, if I care about success in that particular domain, and you don't always have to care, but if you do care about success, you need to go outside of yourself and look at your community because they are the key to your success.
Don't hide your light under a bushel.
Absolutely. Thanks for having me.
Okay, Laszlo, thank you so much, and I hope we can have you on again someday. Are you working on another book?
No, after every book, I like to have a 4 or 5 year break. So yes, I am working on a book, but that's a much more technical book, not general audience. We're writing with my former student, Dashun Wang, a beautiful book called Science of Science that is really taking these ideas into the scientific place and rethinking how science works.
Okay, well, I guess we'll have to wait a few years for another book like The Formula then. But it'll be worth it, I know. Thank you so much for being here, Laszlo.
It's my pleasure. Thanks for picking the formula to feature in your podcast.
All right, that was fantastic, and I highly recommend the book, The Formula, by Albert Laszlo Barabasi. It's called The Formula, The Universal Laws of Success, The Science Behind Why People Succeed or Fail. Incredible. I couldn't put it down. Okay, it's time for the mailbag. And, you know, this is where you get to talk to us, and we can answer your questions and respond to your comments. And look, what I'd really like you to do is tell me what you like and what you want more of in the podcast. Do you want more interview? Do you want more of the opening rant? Do you want less of the opening rant? You want more news? What is it that you would like more of? We'd really like to know. So if you could write to us at feedback@investorhour.com and tell us that, that'd be really great. Thank you. The first one is from Michael O. And Michael O says, first, as an economics professor, I was happy to hear your explanation of discounting in a recent episode. This is something I teach in my natural resource economics class, since it is so central to valuing resource streams, but it is surprising to me that it does not come up more in other contexts. In working with people in the finance offices of colleges, I have been shocked to find out how many people don't understand this very basic idea. And these are people running the finances at these institutions. Also, out of curiosity, I grilled up a few Beyond Meat burgers this weekend to see what the hype was about. While I will say that they did look like real beef burgers, they still taste like peas, and they smell like peas when they are on the grill. There is certainly no way you could give me one of these and fool me into thinking it was meat. So as far as I can tell, the huge breakthrough that people are paying insane prices for is that someone came up with a way to make peas look like meat. We will see a plunge in this one before too long. Very much enjoying the shows, and I am also a lifetime subscriber to Extreme Value. Keep up the great work, Michael O. Thank you, Michael. Michael is talking about, 2 episodes ago, we talked about the very basic core of how to value a business, and it's a process called discounting. And I tried to make it as simple as possible because it's kind of technical and mathematical. And I think I did it. I think I simplified it enough because we got a couple good emails about it. All right, number 2, Gordon B. Gordon B. writes a very short question. He says, what is the best way to buy gold? Well, Gordon, earlier in this podcast, I think I mentioned that if your desire is to hedge currency risk and get your money sort of out of the financial system altogether, then you buy gold coins or gold bullion or some physical form of the metal, which you then put in, a vault or a safe or someplace. If your desire is to speculate on a higher gold price, then you would probably lean more towards some type of gold equity, like a gold stock of some company or other. And you might be involved, I mentioned gold futures because technically that's a way to speculate on movements in the price of gold, but I'm not recommending anyone do it, okay? I'm just telling you it's out there. But those are really the 2 that I think anybody in the sound of my voice has any business getting near, right? Physical gold, coins and bars, and gold stocks. Okay, number 3 here is from Jacob H. Jacob H. says, hey, Dan, love the podcast, as you should know that by now. He's written in before, that's why he said that. And he continues, he continues, wanted to ask this a while back, but was busy with life. You quoted Warren Buffett saying that if interest rates stay at these levels, then stocks are cheap. Why does the interest rate change the value of stocks? Is it because if money is cheap, then companies will invest and grow, thus growing earnings? Or will investors need to invest in stocks as bonds don't really give a good return or completely something else? We'll be waiting to hear from you during the mailbag. Make it a great week. Jacob H. All right, you're hearing from me, Jacob. And you're in the ballpark. You have a good feel for the meaning of this. You say, is it because if money is cheap, companies will invest and grow, thus growing earnings? Sure. If money's cheaper, they can borrow it more cheaply or maybe even borrow more of it and invest it and grow or buy back stock or whatever they're going to do with it. And then you say, or will investors need to invest in stocks as bonds don't give a good return? Again, yes. People think of alternatives. So if bonds are yielding 1% and stocks are yielding, 3%, then stocks are more attractive. And of course, bond yields, the bond coupon doesn't grow. the coupon or the earnings with stocks, they can grow. And some of the larger, more stable kind of businesses are actually seen as bond-like substitutes. I don't think that's true. I think that's a bad way to look at them, but that's the way some people think about them. And so, yeah, I think you understand exactly what's going on here. Interest rates stay low, and it forces people to think about other alternatives, and equity is the big alternative that they think of. And it also works inside each business in terms of the amount they pay to borrow money. Good question. Number 4, last one. This is Chaz B. And Chaz B says, Dan, greatly enjoy your hosting of SIH. You and your knowledgeable guests have helped me develop a better understanding of markets and how to invest in them. I hope you get as much out of doing the podcast as we do listening. Rather than a rant, I suggest you do a perturbation at the beginning of each show. As a former neurologist, I like the definition of deviation of a system, moving object, or process from its regular or normal state or path caused by an outside influence. I think that's the definition of a perturbation. And then he continues, what you are doing is perturbing your listener's way of thinking about the markets. The expectation or hope is that you will get listeners to think in a different way about how they invest. This is what has occurred for me over the past 6 months. Keep up the great work, Chaz B. Well, I called today's rant a perturbation. I'm not sure if I'm going to really go with that one every week because it's a little unwieldy, but thank you for the idea, Chaz B. And, you got me to do it once. Maybe I'll do it again. Who knows? But that's it for another episode of the Stansberry Investor Hour. And yes, Chaz, I really do get a lot out of these podcasts. It's my privilege to come to you all every week. I really enjoy it. So be sure, folks, that you check out our website where you can listen to every episode and you can see a transcript from every episode. And you can enter your email in there and to make sure you get all the latest updates, right? Just go to that same address, www.investorhour.com. Okay, one last thing, folks. Every year we do a fabulous conference in Las Vegas. It's like my favorite thing to do with Stansberry every year. I mean, it's just a good time. I mean, it's Vegas. Hey, good time. And we're going to do our little conference again this year in October. It's a 2-day thing. And then on the third day, we have a meeting for our Alliance members. So if you want to be an Alliance member, if you already are one, you can join us for 3 days. But the 2-day conference, we have a special discount that we give you for listening to the podcast. And to get that, all you have to do is go to investorhourvegas.com, Investor Hour Vegas. And you can sign up there and we'll take a couple $100 off of the registration fee for the conference. And I mean, there's people like, well, of course, there's going to be Porter Stansberry, Steve Sugarud, Doc Eifrig. But this year we're going to have Dennis Miller, the comedian, Nouriel Roubini, the famous economist who predicted the financial crisis, and just a couple dozen other people giving really great talks over a 2-day period. And, I'll talk once or twice, and I'm going to play guitar at the VIP reception. So maybe you can see me there. And I just hope you'll come to Vegas and join us. It's a really good time, and there's lots and lots and lots of great ideas that you probably won't get anywhere else. InvestorHourVegas.com. All right, that's it for another week. Thank you so much, and I'll talk to you next week. Bye-bye.
Thank you for listening to the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email at feedback@investorhour.com. This broadcast is provided for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.